Building wealth is already challenging, but when nearly half of your income goes to taxes, it can feel almost impossible. Many people find themselves stuck in a frustrating cycle. First, they struggle to earn more money, and then, when they finally succeed, they have to fight to keep it from being eaten up by taxes. It's a never-ending battle. However, there is a way to build wealth and reduce taxes at the same time. The ultra-wealthy understand this concept very well. They legally structure their finances so that they pay little to no taxes, often getting away with paying 0% on their income. The good news is that you don't have to be ultra-wealthy to take advantage of these strategies. Anyone can do it as long as they understand tax-deductible investments. These are specific investments that reduce your taxable income, allowing you to keep more of your hard-earned money while building long-term wealth. Before we go into specific investments, it's important to understand the importance of tax planning. Tax planning is the process of organizing your finances in a way that helps you pay the least amount of taxes while following the law. It helps individuals and businesses save money by using tax deductions, exemptions, and credits wisely. When you plan your taxes properly, you can keep more of your hard-earned money and use it for important things like savings, investments, or business growth. For businesses, tax planning ensures they manage their finances well, avoid unnecessary tax payments, and stay profitable. It also helps in avoiding penalties by ensuring taxes are paid on time. For individuals, good tax planning can help with long-term financial goals, like buying a house, saving for retirement, or funding education. It also reduces stress during tax season since everything is well organized. Now, let's explore the different types of investments that qualify for these tax deductions. We will start with traditional IRA, individual retirement account. It is one of the easiest ways to get a tax deduction while saving for retirement. Anyone can open a traditional IRA through a brokerage firm like Fidelity, Vanguard, or TD Ameritrade. You don't need an employer to set it up. Here's how it works. You can contribute up to $7,000 per year, $8,000 if you're over 50. When you contribute to a traditional IRA, you get a tax deduction for the amount you put in. If you're in a 37% tax bracket, this means you save 37% of your contribution in taxes. If you have a spouse, they can also contribute another $7,000 or $8,000, increasing the tax saving potential. The best part? Your money grows tax-free inside the account until you start withdrawing it in retirement. If you expect to be in a lower tax bracket when you retire, you will end up paying much less in taxes overall. A traditional 401k is another tax-advantaged retirement account, but it differs from an IRA in that it is set up through an employer or a business. The biggest benefit of a 401k over an IRA is the much higher contribution limit. If you have a job, you can contribute up to $23,000 per year to a traditional 401k, and this entire amount is tax deductible. If you're self-employed, you can set up a solo 401k and contribute up to $69,000 per year, including employer contributions, which means a $69,000 tax deduction. Even better, you can combine a traditional IRA with a 401k, maximizing your tax deductions even further. If both you and your spouse contribute to these accounts, you could reduce your taxable income by over $76,000 in 1 year, assuming one person maxes out a solo 401k and both contribute to IRAs. This is money that would have been taxed, but instead gets invested for your future. Health Savings Account, HSA, is another powerful tax-saving tool, and unlike retirement accounts, it allows individuals to spend the money tax-free on qualified healthcare expenses. Unlike retirement accounts, HSAs allow you to spend the money tax-free on qualified healthcare expenses. Here's how it works. You can contribute up to $4,150 per year for individuals or $8,300 per year for families. 2024 limits. The money you contribute is tax deductible, meaning you lower your taxable income by that amount. But the real magic happens when you invest your HSA funds. Just like with an IRA or 401k, your money can grow tax-free inside the account. And when you spend it on medical expenses, you never pay taxes on it. This means that if used correctly, your HSA money is never taxed, ever. For those who donate to charity, a donor-advised fund, DAF, can be an excellent way to maximize tax deductions. Normally, when you donate to charity, you only get a tax deduction for the year you make the donation. But with a DAF, you can contribute a large lump sum, take a huge tax deduction all at once, and then distribute the money to charities over time. Another advantage is that your donations can be invested and grow tax-free. This allows you to give even more money to charity while reducing your tax bill significantly. Owning a small business is not only one of the fastest ways to build wealth, but it also comes with some of the biggest tax advantages. Unlike regular employees, business owners pay taxes after deducting their expenses. This means that instead of paying taxes first and spending what's left, they write off their expenses first, then pay taxes on the remaining income. Some common tax-deductible expenses for business owners includes office rent or mortgage, utilities and internet, business-related travel and meals, advertising and marketing, vehicles and transportation, and health expenses. These tax deductions can save business owners tens of thousands of dollars each year. Real estate investments are another highly effective way to build wealth while benefiting from tax deductions. One of the most powerful aspects of real estate investing is depreciation, which is a non-cash deduction that lowers taxable income. When an investor purchases rental properties, the IRS allows them to deduct a portion of the property's value every year as depreciation, even though they are not actually spending any money. In many cases, depreciation alone can eliminate most or all of the taxable income from rental properties. On top of that, real estate investors can also deduct mortgage interest, property taxes, maintenance costs, insurance, and other property-related expenses. Those who qualify can take advantage of accelerated depreciation, which allows for even larger deductions in the early years of ownership. This strategy is commonly used by high-income earners who want to significantly reduce their taxable income while building wealth through rental income and property appreciation. Unlike traditional stock investments, real estate provides both cash flow and tax benefits, making it an attractive option for those looking to minimize their tax liability. Another tax-efficient investment that is often overlooked is oil and gas investing. Investing in oil and gas can provide huge tax deductions. The government offers massive incentives to encourage investment in energy production. When you invest in oil and gas projects, you may be eligible for intangible drilling cost deductions, which can deduct up to 85% of investment costs in the first year. However, the exact deductions depend on the specific investment structure and IRS rules. As you can see, the tax code is designed to reward people who make smart financial moves, whether it's saving for retirement, investing in real estate, starting a business, or even contributing to a donor-advised fund. The key takeaway here is that you don't have to be ultra wealthy to take advantage of these tax-saving strategies. If you found this video helpful, be sure to hit that like button and subscribe to the channel for more strategies on lowering your taxes and building wealth. Also, drop a comment below if you have any questions or if there's a specific tax strategy you'd like me to cover in a future video. Thanks for watching, and I'll see you in the next one.